Okay, good morning everybody. Good morning Renaud, good morning Kareem. So let's just get right into it. We're not going to do introductions because I think, Renaud, I think everybody will know who you are. Why don't you just tell us a little bit about what's the state of play in consumer credit today?
All right, good way to start. So I think generally, US consumer is in a good place. It's been really up and down. Last year was a lot of complicated and sometimes sort of head-scratching data on underwriting, where sort of the economic activity was still pretty good. So the unemployment rate still very low by historical standards, and yet delinquencies were like ramping up. And part of that was normalizing back up post-pandemic, but then it breached the pre-pandemic levels and delinquencies continue to rise across all asset classes. I think now we're seeing at least some stabilization in the situation. And at Upgrade, we have quite a bit of visibility into the US consumer. Right. We have about 5 million customers. We get about 8 million applications every quarter across mobile banking, credit cards, personal loans, auto loans, home improvement financing, travel, BNPL. So it's quite a few data points. And what we've seen just in the last few weeks, so it's pretty recent, is really delinquencies stabilizing. So it's not improving yet. It's not coming back down. Still see some stress in some areas. We don't have mortgages, but mortgage is an area of concern. Auto continues to be sort of up and down, with collateral value continuing to be a little bit disrupted. But generally, if you look at the sort of high-level metrics, like the debt-to-income ratio, for example, or the St. Louis Fed publishes this debt service as a % of disposable income. Right. For US households. And historical average is about 12%. We're still below 12%. Right? So debt level has been rising, but now with some wage inflation on the back of that, so wages have risen too. So debt-to-income ratio is pretty much where it's supposed to be. And again, delinquencies are stabilizing. So it looks like we're in the right place for this year.
Well, that's good to see. Some green shoots maybe starting to form. So, Kareem, I know you don't have the same name recognition as Renaud, I'm afraid. So why don't you just introduce everybody, tell us a little bit about FairPlay. What do you guys do?
Yeah, thanks, Peter. Well, FairPlay is the world's first fairness as a service company. We make software that allows anybody using a predictive model to answer 5 questions. Is my algorithm fair? If not, why not? Could it be fairer? What's the economic impact to our business of being fairer? And finally, did we give our declines, the folks we rejected, a second look to make sure that we didn't say no to somebody we ought to have approved? Some of the biggest names in American finance, including Upgrade, use our software to automate their fair lending testing and reporting, and to run second look programs designed to find more good loans within their risk tolerance that also pay an inclusion dividend. The upshot of all of that is that our customers are able to increase approval rates on the order of about 10%, increase take rates on the order of about 13%, and increase their fairness to protected groups on the order of about 20%. So we like to say that fairness is good for profits, good for people, and good for progress. Right.
And as you were saying backstage, I mean, most people want things to be fair, right? So Renaud, wanted to talk to you about this specific topic. Were you being fair to your borrowers before FairPlay? And if not, I guess what's in that question is, why did you bring on FairPlay into your company?
I hope we were being fair. I think we were being fair at great cost and a lot of friction. I think what FairPlay really does for us is simplifying that process greatly, making it more cost efficient. I mean, you know how we used to do sort of back testing, right, for like Reg B, disparate impact, fair lending, all these questions. You would sort of aggregate all your data, and maybe once a year, or if you're like really diligent, once a quarter, you would like ship all that data to do a sort of fair lending audit to an outside company, and you had some sort of experts sifting through the data and using an algorithm to review the data and understand if there was any possible violation, or in general if lending decisions were being fair and no disparate impact on protected categories. And so by the time you aggregate all the data, you ship it out, I mean, you've done a bunch of work, and you get the result back with a 6-month or a year lag. FairPlay is tightly integrated with everything we do. It's highly customizable, and it's real time. So we get that feedback in real time. We continuously improve, continuously tweak. We always get into new products. There's always some shift in the population, in consumer behavior based on economic factors and sociological factors. And so that data and those results are always changing. And so having a solution like FairPlay that's really sort of integrated with everything we do, gives us that feedback in real time, is really invaluable to us.
So that means you can, if you find that there is maybe certain pockets of the prospects that you're bringing in that are being unfairly declined, do you then adjust like on the fly? I mean, how does it actually work?
Exactly, we upgrade it. It's a big part of what the values we preach to our customers and how we behave internally. It's like constantly improving and being very sort of iterative in the process. And FairPlay helps us do that in quasi real time and really get that data. And it's now I think we can treat compliance finally now the same way we treat credit underwriting. Just making tweaks to the model, running the model, and analyzing the data, and then continuing to make changes.
Right. So then, Kareem, can you just dig in a little bit and like, how are you able to go into a company like Upgrade? I know you have other big names in your portfolio. Every one of them is going to have slightly different systems, and yet you're able to do this real-time kind of analysis. Can you just take us through some of the technical side of how you're able to do that?
Yeah, sure. Well, we always start by understanding our partner's business so we can configure the tool to be appropriate to their credit products, where they play in the credit spectrum, and their business objectives. But once we get that initial configuration set, the system is highly automated. The first step is always to run what's called a process of demographic imputation, because most lenders don't know who's black, who's Hispanic, who's a female. And so the regulators have prescribed a certain methodology by which we can approximate the demographic class membership of certain groups. And that allows us then to start running computations like, at what rate did we approve women relative to men? If there are differences in outcomes for one group, what variables are causing those differences? And could we reweight our emphasis on certain variables in ways that allow us to maximize their predictive power, but minimize their disparity driving effect? And I think that's what's really cool about this new era of fair lending analytics, is this ability to, in an environment, frankly, of rising interest rates, rising inflation, rising delinquencies, lenders have to stay nimble to survive, and you can't be nimble if you're stuck in compliance.
Right.
So as Renaud was saying, you have to be as sophisticated at compliance as you are at the other parts of your business. You can't have underwriting for the digital age and compliance for the Stone Age. And so pioneers like Renaud understand that, and they're increasingly leveraging our tool to be able to move quickly in a choppy environment without creating new regulatory and reputational risks for their business.
Right. So does that mean that disparate impact is now a thing of the past for lenders, or what are you?
Unfortunately, I don't think it's possible to be perfectly fair to everyone all the time. One of the great challenges of fairness is that sometimes fairness for one group comes at the expense of another. And so what we try to do is create tools that allow lenders to do right by all of their customers as much as possible, given the constraints that they operate under with respect to cost of capital, delinquency rates, et cetera.
Right, right. So then, similar question to you, Renaud. Do you feel like this is an inflection point when it comes to, you know, the whole fairness question? Because I mean, we've had conversations at our events over the years on this very topic, and it feels like always felt like it was a hard problem to solve. Do you feel like it's now a solved problem?
Well, no, but it's getting closer. I think this is really sort of moving in the right direction. And I think in general, I mean, you see like so many like sort of reg tech, has been a big area of fintech. And so there are more and more solutions, some AI-driven, some more traditional, that really help lenders and fintech companies sort of be more compliant at lower cost in a way that's more automated. Because I think the risk you run when compliance is a manual process is sort of multiple layers of risk, right? When it's a manual process. One, it's really not fun for compliance folks to sort of do repetitive tasks all day long.
Right.
And when people don't have fun, you get more turnover and less job satisfaction and a higher error rate, because if you're doing the same thing over and over again, at some point you lose focus, and that's human nature. And two, I think by sort of automating, you really sort of get more consistent feedback. Right? You tighten that feedback loop. You know exactly what you're doing when you're doing it, and the sort of improvement process, this feedback mechanism runs a lot faster when it gets automated.
Right. So then how did you adjust when you bring in an organization like FairPlay, and like you've got people that were doing these processes that would send away tapes for 6 months to get analyzed? Like, how have you adjusted that internally? Are you is it saving manpower by doing this, or how is it sort of operating internally?
So it could be saving manpower, that's what you're focused on. What we've decided to do is sort of more like redeploy the same resources to analyzing the data and understanding what the data says and proposing changes, and doing this much faster, on a faster cycle than we used to, so that we drive improvements faster. Right.
So then, just talking about compliance, and Kareem, I wanted to sort of, with the current regime in Washington that we have, seems to be very supportive of the work you're doing. They really, there's an emphasis on fairness that there wasn't 4 or 5 years ago. Do you think now this can be a competitive advantage for people in the market? I mean, how do you kind of, maybe just take a step back, how can compliance be a competitive advantage?
Well, look, corporates are adopting AI at a massive scale, at a time when the consumers who represent the future of the financial services business are demanding fairness from their governments, from their employers, and from the brands that they patronize.
Right.
And so, the question is, how can we, AI is poised to dramatically enhance the profitability and efficiency of our firms. But the key question is, how can we achieve those gains in a manner that doesn't pose a threat either to the safety and soundness of our institutions or to the consumers we serve? And there, what's really cool is I think a lot of companies are investing in fairness regardless of what's happening in Washington, in part because the technology permits them to do it. I mean, so just to give you one example from the world of self-driving cars that is now applicable in financial services, every time you build an algorithm, you must give it a target, right? Some objective that it seeks to relentlessly maximize. And historically, algorithms only had a single target, right? So, I mean, and if you think about it for a second, giving an algorithm a single target can result in all sorts of unintended consequences. So like imagine for a moment that Tesla gave the neural networks that power its self-driving cars the mere objective of getting a passenger from point A to point B. Well, the self-driving car might do that while driving the wrong way down a one-way street or blowing through red lights or causing mayhem to pedestrians. So what does Tesla have to do? Tesla has to give the algorithm that powers its self-driving cars two targets. Get the passenger from point A to point B while also respecting the rules of the road. And what's cool is that this same technology can now be applied in financial services. Determine who's going to default on their loans while also minimizing disparities for protected groups. And the great news is it works.
So are those two things aren't necessarily at odds, right? I mean, that's the...
No, in fact, done right, we see that actually you can increase approval rates within your risk tolerance, increase take rates, and increase fairness. So good for profits, good for people, good for progress.
Right, okay. Okay, so then just talking about that, like Renaud, you've obviously got a lot of experience in consumer underwriting, and you've been doing this now, God, it's going to be almost 20 years, but...
Lots of gray hair.
Yes. So when you're like, you look at all of the sort of evolution of the process of, from what, linear regression all the way through to what we're doing now, how is this sort of changing, does it really change the approach of how you underwrite, or is this really like an add-on tool that you're using?
Yeah, no, I think every bit helps, right? So it's just yet another tool that helps us focus on what we like to focus on, which is driving product innovation for the benefit of consumers. Mm-hmm. And obviously, when you innovate, so you sort of reach new ground, and it's uncomfortable sometimes. And so when we launched the Upgrade One card, which is this card that can be used both as debit and credit card, or like pay now and pay later, it's the kind of card that had never been done before, and that gives rise to novel sort of legal questions and compliance questions. Right. And like suddenly you're like in the middle of sort of debit and credit compliance questions, and so you really need tools like FairPlay to sort that out, to free people up from sort of repetitive, low-level compliance tasks. So get an algorithm to do the work, so that people can look at the data and can sort of not see compliance as something they need to worry about, but really as a competitive advantage. Right. If we can do compliance better, if we can do it faster, that frees us up to innovate and drive value for consumers.
Okay, that's a good point. Okay, so as we wrap up here, maybe we said that this is not yet a solved problem, but what does the future hold? Do you envision a world where this is a completely solved problem?
Look, I think it is very challenging, as I said earlier, to be fair to everyone under all circumstances. The question is, have we done as much as we can to narrow disparities while also achieving our other business objectives? And I think that is clearly where the winds are blowing. And so our mission is to help our partners, like Upgrade, responsibly grow their businesses and deliver the fairest financial products possible to their consumers.
Right. Okay, well, we'll have to leave it there, Kareem. I think it's a noble cause. I think it's something that's really important for the industry. So thank you for joining us. Thank you, Renaud. Always great to chat.
All right, thank you.